I forgot to start recording. So I'm going to start recording right now. So this is the Northwest Chamber, and we are happy to have our speaker today, Robert Carter. He is a partner at one of our members, Hertzbach and Company, right here in Owings Mills, Maryland. And he is works within the forensic division, which is a really interesting department that we found out about. So I'm not going to take up any more time. I wanted to give as much time as possible to Robert. He is going to explain to us why it's not just the big businesses that have to worry about employees and vendors stealing from them. It's us. It's the small businesses as well, and he has seen it firsthand. So Robert, welcome, and the floor is yours.
Thank you, Kathleen, and welcome everyone. I really want to start out with a short story, and it doesn't have to do necessarily with fraud in a business, but I think this is really helpful kind of to set the stage. So I was talking with another forensic accountant that I work with pretty regularly, and he had a client reach out to him that thought that somebody was stealing from him. He was a recent lottery winner, and he had about $10 million. And over the course of 6 months, he saw it drawn down pretty significantly. And he couldn't figure out what was going on. And everything seemed legitimate. This forensic accountant started looking at the documents. And the more he's looking at it, it seemed really peculiar. Seemed very odd. If I can get my words right here. And he couldn't figure out what was going on. So as he looked more and more into it and interviewed the client, he came to realize that the client was actually stealing from himself, and he didn't know it. So what happened was the client actually had multiple personalities, and at various points in time, he was taking money out of the account, and this other personality didn't realize that he was taking the money from himself. He ended up hiring multiple attorneys, multiple forensic accountants, and when these people started requesting documents is when they found out that they all existed and they were all involved. So the reason I bring this up, because I know it's not exactly what we're talking about today, is that you might get a tip at some point, but don't just take what you've been told at face value. Make sure you look into it a little further, whether you need to hire a forensic accountant or not, that's obviously a later step, but make sure you investigate a little bit and use some judgment. Not that someone just told you this person was stealing, so therefore they have to be stealing. I just want to set the stage from that standpoint, because it's really important that as a business owner or somebody involved in business, that you are taking care of your company, but also managing how your employees are reporting to you and what potentially could be happening within your business. So what is internal fraud? Generally, this is called occupational fraud. The idea is that it's somebody that is using their business or their place in the business as an employee to be able to commit fraud. So it's giving them that opportunity to actually do this. And fraud typically falls into one of three categories: either a corruption, financial statement fraud, or asset misappropriation. Generally, what you're going to see, especially for smaller businesses, tends to be in the asset misappropriation category. But just be aware that some of these are available to some of your employees. One of the ones you'll see occasionally, depending on what industry you're in, is bribery or conflicts of interest. You might have someone selling product or buying product from a friend or family member, and your company may be paying too much or too little, depending on the situation, or being reported at the wrong amounts, or again, they're getting kickbacks, and therefore they're willing to overpay because they're getting a portion of that back. Financial statement fraud, you may see that if you're a bank or you're working in those situations of a potential borrower sending you a financial statement that's incorrect. Another area you might see is a CEO of the company that you hire that's a non-owner is trying to make the financial statements look better to get a higher bonus. So you can be aware that some of these things can exist in some of these other businesses. Asset misappropriation is the most common one you'll see. That could be just someone taking money out of a cash register, could be stealing inventory. One that's really common is expense reimbursements and not having adequate support. That could be an issue even right now while we're all working virtually, because of the fact that you may not see these people on a daily basis. You don't know exactly what your employees are doing. If they send something to you and explain that it may have been necessary, you may not question it. But make sure you're looking to see that they actually paid it and that they have support for those numbers. There are also ghost employees and shell companies, and I can get into those a little bit more as we go, but those are other areas you want to keep an eye out for. So why do people commit fraud? This is really important, especially for small businesses. There are usually three elements. There's pressure, opportunity, and rationalization. At least one of them has to exist for someone to be willing to commit fraud. There either has to be a pressure to do it. Usually it's a financial pressure. They need the money. They can't make their mortgage payment. Again, that might be something that's happening right now, given the pandemic. There has to be the opportunity, because if they need the money but they can't get to it, they can't commit fraud. But if there's an opportunity for them to actually do it, that's something to keep in mind, because they will find a way to manipulate the current rules to commit some sort of fraud in your business. And then the other one usually is rationalization. That's essentially saying, well, I did this because I wasn't being paid enough, or I needed the money for right now to get by until the economy's okay. So it's okay that I stole it, I'll pay it back later. At least one of them has to be present. Usually all three are when fraud actually happens. So keep an eye out when you're dealing with your employees to see if there's any issue where these three might be present. So just an example, and some of you may have heard this story before, but I just wanted to bring this up because this was a pretty significant one. This was a nursing home where we were brought in to do a forensic investigation. And the core staff had been at the company for a long time, about 20 years, 30 years almost. And essentially this was the business office coordinator who was working with the residents as well as the company and collecting the receivables and marking off on their accounts. Essentially what was happening was this business office coordinator was keeping the money that came in. So they were taking the actual cash payments. They were also taking cash withdrawals from the residents' accounts because some of the residents weren't able to handle their own accounts. Some cases they were forging resident signatures, which was a big deal. Now, every fraud is going to be a little different. In this case, it wasn't overly sophisticated. This person didn't realize that you couldn't deposit a check twice. So they deposited the check the first time, tried to change a name. They essentially just whited it out and wrote another name, their own name on it, and tried to deposit it again, which didn't go through. And then they also were keeping cash, the overall cash that was coming in that was just extra in addition to any other payments. So this was a situation where, because they were keeping the actual payments for one of the residents to actually stay on the facility, they were seeing this past due account, and they were about to discharge this individual because they hadn't paid for months. Ultimately, the family was able to keep the receipts and show that the money actually was paid, which is what kicked off this entire fraud investigation. But at the time, they were about to get rid of this resident who needed to be there and was actually making their payments. So there are usually some sort of mess ups like this, or a tip that comes in is usually how these frauds are discovered. But this is an example of money was being stolen from the residents, not so much so from the company, although obviously the company would have had that as revenue. But just be aware that this isn't a type of fraud that could happen that you may not see because it never hit your financial statement. But also consider, like I said, in this case, the legal ramifications of the lawsuits that may have existed beyond just the loss of revenue. So here are a couple examples of how frauds are detected. The tips being the most important. So you'll hear me a bunch of times today say to focus on tips because 43% of frauds are discovered because of tips. But usually you'll see internal audits, management reviews, accidents are very common just because things happen and you don't realize it. And then just doing external audits, forensic accounting, controls, those all help, but I always want to focus on tips because as much as you can put in place, that's one of the most important, but you need to then have a way of figuring out how do you act on those tips. So this was another one we had, which it was a property management company. And essentially what they were doing was hiring an external person to do some of the repairs. The employee that was responsible for hiring the person ended up hiring a friend of theirs to do all the work, which in of itself isn't a big deal, other than you want to make sure that they aren't paying too much for the services. In this case, they were paying them multiple times for the same work that was being done, and then splitting the cash that was paid with their friend. Some of the examples here were that they were painting the same door, 4 times in a couple months, or they did snow removal when it didn't snow. There's a couple times they were paying for snow removal on the same day for multiple times. Things along those lines would happen. So this ended up being discovered because the monthly expenditures didn't match up with where they were prior to that individual being on the books. So it was just a review of the actual books and records. And this wasn't a large company. We're talking about a company that was doing about $200,000 or $300,000 of revenue. So just be aware, this doesn't all have to be large companies. The other issue were complaints from residents about difficulty dealing with a particular employee, and that was the employee that was hiring his friend, and he was trying to divert all the work to his friend. And so if that person was busy, he was telling the residents that they couldn't have anyone come to see them and take care of them because he wanted to wait until that person was available. So listening to complaints, tips, looking at the books, all are important in discovering frauds. So in this case, as I was going through it, we noticed that the payments to the vendor were approved by the one person, and there were never any check requests. There was a requirement here to have check requests. So if you have an internal control, you need to make sure that your employees are actually following those internal controls. There wasn't an address for this particular vendor. The check always had to be picked up. And the reason for that was because the check wasn't for the full amount, or they were keeping part of the amount. There were checks that were in the system that were for that vendor but went to the employee. Again, that was because one check would go to the employee, the other one would go to the individual vendor. And then the checks were signed and endorsed by the employee and went into the employee's bank account. But again, the important part here is that employee didn't actually have signing authority. So if someone was keeping track of those things, that wouldn't have happened. In this case, there's about $40,000 stolen over 3 months. And for a company that was about $200,000 or $300,000 in revenue, that was pretty substantial. So similar to the way you can detect fraud, you can prevent it in similar ways. So you look at external audits, having a code of conduct, internal audit. I'm not going to read through all of these, but these are important to look at because they're all ways you can deter the fraud. And sometimes those, just the appearance of them, are enough to deter, more so than the fact that they will actually find the fraud. If your staff know that there's going to be surprise audits, they may not look to steal money. If they know that they're going to have to rotate their job with somebody else in their department every 2 or 3 months or every year, they won't want to try and commit fraud and cover it up because they know someone else will figure it out when they look at it. So consider a couple of these because they may be a good way to determine how to stop fraud or figure out a way to stop people from even having that opportunity, as well as the rationalization because they know they're going to get caught. Like I was just mentioning, sometimes the deterrent of fraud is more important than the actual prevention approach you take. But the most important deterrent comes from the tone and the culture the management sets. It comes from the top. So I always say you have to lead by example. So if your employees see you stealing, and I realize it may be your company, but if they see you skirting the rules that you put in place, or again, you have maybe a CEO or CFO or somebody else you're allowing to get away with things, they're going to start doing the same thing because that's part of the rationalization, saying, well, management's doing it, so why can't I? It's also important to realize that even organizations that have some internal controls can fall victim to fraud. Every company should have internal controls, but no matter what you do, people are going to find a way to circumvent them. But it can stop fraud because it makes it harder to commit, and also it might be, again, a deterrent from people to start in the first place. Some of the most effective controls that I would suggest you look into, put into place at your company, would be job rotation and mandatory vacation. Was the first one. I think that's incredibly important because if you have the people available, say you have an accounting department of at least 2 people, have them switch roles or oversee what the other one does every so often so that there's kind of a reason to not commit fraud. Also, mandatory vacation. It's really common for someone that's committing fraud to not want to take time off because they think it'll get discovered while they're not there. Having surprise forensic audits or investigations is important. Again, whether you do that yourself, internally, that's fine, but just having something that employees know is coming will be helpful. Proactive data monitoring and analysis. Again, this comes to look at where things are now, where were they 3 months ago, 6 months ago, a year ago, and just making sure you're looking at variances and trying to determine why things are different if they are. And then segregation of duties is really important. You don't want someone to be able to cut the check, sign the check, deposit the check, and then record it in their general ledger, because then if they can do that, they can manipulate it so you'll never find it. So make sure you have different people that are doing those jobs. In a small business, it is tough, but again, maybe it's something where you're the only person that can sign. or at least you're monitoring the bank deposits. Things along those lines, you at least can, whether you do it yourself or find somebody that can help out with one of those responsibilities so that someone can't do the entire gamut of recording and cutting checks. This was a situation where the internal controls were kind of gotten around. So there was a long-time controller for a large financial company, and I say large, not huge, but larger in terms of a small business. There was really minimal oversight for all the employees, and the controller was responsible for doing what I just said. They were recording it, they were initiating and releasing the ACH payments, and they were writing checks. And they were able to do all of that without anybody paying attention to what they were doing. And the controller also managed all the other accounting functions. So again, another segregation of duties issue. The fraud that was committed was that they were duplicate paying invoices. So they would pay an invoice and then say the check was lost in the mail. I cut another check, but the second one really went to them. The first one made it to the original payee. So no one was taking a look at that. They were misstating expense reimbursements. They were saying they went to conferences when they really didn't, and then getting reimbursed for thousands of dollars for travel, hotel, everything else. They would write checks and write it in erasable ink, and then they would change the name of the payee for the few checks where they had to have some sort of accountability and someone else sign off on it. The biggest issue actually was a banking issue, but no one was checking the bank statements behind this person. And there was supposed to be dual approval on ACH payments, but the bank accidentally set it up where they only had to have one approval, and she was one of the people who could approve it. So she was sending herself ACH payments. Again, if someone was recording these entries in the general ledgers or someone was looking at the bank statements, any of this could have been caught. Again, it comes down to that segregation of duties issue or even job rotation, because then they'd start noticing why is money coming out with this person but not coming out with this next person in the same role. This was interesting because it was figured out by a tip. This was really a funny situation that most time people don't believe, but it was simply an acquaintance of the perpetrator. Essentially, she went to the bank to deposit a check that was written to her from the company. The teller knew the controller through the school PTA where this person had stolen from the PTA. So she figured she would call the company and confirm that this check was legitimate and it was supposed to go to this person. By doing that, they found out it wasn't, and that's what tipped them off that something was happening and started the actual forensic investigation. So once we started going through here, we noticed that ACH issue. We found the copies of the invoices and the fake invoices, and they looked very similar, and we were able to trace some of the payments there. We saw the erasable ink in her desk, and we were able to see some of the changes of what was recorded in the QuickBooks and what was not. Overall, this person stole about $650,000 over an 8-year period. So again, I know it's a slightly larger company, but these things happen, especially with small businesses where you may not have a robust accounting department. You may only have 2 or 3 people doing most of the roles. So trying to find the best way to either oversee or at least have some segregation of duties is going to really make a big difference. And again, I know I keep bringing this up, but when when frauds occur, most of the time it's because there isn't a segregation of duties, because that fraud triangle can be met very easily by one person. By having the segregation of duties, again, it makes it a little harder because they can't physically do it. They have to find a way to bring the other person into their fraud if they're going to get by. The 3 basic types of functions you're going to have, and from this accounting standpoint, is the approval process, the actual accounting of the transaction, and then the asset custody. The idea being the approval, who signs the check, the accounting and reconciliation of who's putting it on the general ledger, and then the asset custody of who has the checks in their possession. Try and keep those 3 separate if you can. Or if you can't, as the owner or higher ranking person, try and take care of 2 of the 3. So that way you're not worried about people having it's too easy to steal from you. The idea is that no one employee should have more than one function. Again, if you're the owner, that's a little different. This is an interesting situation because this is 2 owners where one of them was stealing from the other owner. And this is incredibly common in small businesses. And not that I want anyone to be worried about their partner stealing from them, but it is something to keep in mind because this does happen. So there were 2 partners that each owned 50% of this business. for the last 40 years. So they're both getting close to retirement age. Partner A had stepped back over the last 5 years. He was working remotely 2 to 3 days a week and hoping to retire within the next year or two. Partner A had also agreed to be bought out of the company. Something I think was interesting to note is that there was an offer to buy the company about 3 or 4 years back, and they decided not to do it while partner B was going through a divorce. So what happened was that partner B started running his personal expenses through the business when partner A wasn't in the office as much. Partner B brought on his girlfriend and put her on the payroll. He also helped his girlfriend create shell companies. So what I want to call a shell company is essentially she would go and register a company. So it was legitimate. It would show up on the Maryland SDAT. And then she would create invoices for these companies saying it was for legitimate business purposes and have checks cut to those companies where she was just keeping the money and work wasn't actually being done for the company. But to anyone just looking at the books, they looked like legitimate companies because they were. In terms of the payroll, I'll go back to what I talked about earlier as a ghost employee. She was set up on the payroll under her maiden name, but she also was divorced and had her name when she was married, and that name was also on the books. And what's a ghost employee is where you see one or more employees that aren't individual or people that are working for the company, but might be getting a paycheck. And so when you look at the payroll, you can see that there were 2 names that were very similar, at least the first name. They both had the same address, same account that was being deposited for direct deposit. And you can see that there really shouldn't be payroll to this person, or at least not twice. So just be aware that sometimes you just need to do a payroll check when you're looking at your own books, because if you see a number of people with the same addresses or same bank account deposits, that's probably a situation with a ghost employee where someone's being double paid. So how we figured this one out is that there was a review of the financial results for the buyout. I was brought in not actually in a forensic capacity, but to do the valuation for the company and determine what a reasonable price was. But as I was going through the valuation, I looked at it and said, well, this doesn't make sense. Why is this expense here? And as I started asking questions, there weren't good answers for them. And we started pulling documents to figure out what was actually happening. And we ended up finding a pretty substantial amount that was taken by partner A. Or partner B, I apologize. So partner B actually admitted to the fraud when he was confronted with the investigation results and claimed it's because he wasn't being paid enough. Compensation was that partner A was getting $200,000, partner B was getting $1 million. Even though they were both working the same, doing the same roles, even though one was working remotely, partner A had agreed while he was starting to slow down that partner B would get more. And yet partner B decided to still take more on top of that. The girlfriend registered her entities with the SDAT, created these fake invoices, and then got those paid, which resulted in a substantial amount of money that was being paid. And partner B, essentially when he was taking the money by paying his girlfriend, the fake entities, and also paying his own personal expenses for the business, it was in excess of $1 million a year, in addition to the $1 million salary he was receiving. And the total amount embezzled was $4 million from those areas. On top of that, he also took company brokerage account by renaming it to himself. So again, this is not a huge company. They did pretty well, but I'd still consider them a smaller business. And this was between 2 partners. So not that people shouldn't trust their partners, but make sure you have things in place to keep an eye out for issues like this. This was one of those pressure issues because the theft started during partner B's divorce. He didn't want to show that he was making a lot of money during the divorce, so he took money that wasn't going to show up on his tax return by embezzling the money. And that way he could still get money out, but not have to split it with his soon-to-be ex-wife. So again, just keep in mind that these things do exist. So red flags are really important. These are the items that are letting you know that there may be a fraud that's actually happening. It's a warning sign of potential fraud. Typically, these perpetrators are going to have some sort of behavioral warning. Just look out for these. It's tough virtually, but you can still check in with your employees and try and see what's going on. One of them being they never take the vacation and never delegate the work because they want to be in control of it and not have people find out what they're doing. They always have a really well thought out excuse for things that seem odd. Again, that might be legitimate, but it might not. They seem to be living beyond their means. They're making $20,000, $30,000 a year, but they have really expensive cars, top end everything. Just think that that might be a red flag. If you know they're having financial difficulties, which is something a lot of people are having right now, that's something to then just keep a closer eye on your employees. Or they have a really close association with a vendor or customer. So as you're looking at the information, just try and think, do the transactions make sense? Does the timing make sense? The frequency? Are you paying rent twice every month for one location? Maybe that second rent check is going to somebody. Are there questionable payments to individuals, just people that you wouldn't expect to be paying? Look for those when you're looking at your documents. And same thing, financial performance indicators. Look at prior year, current year. Look at AR one year to the other. Maybe they're writing off AR and actually going there and collecting it themselves. Just look at your budget to actual, keep an eye year to year, and that might tell you if something seems odd, especially if you can't think of a reason why the information should be different. So this is a different situation that has to do with skimming. And this is an organization that was essentially allowed to have some slot machines. And there was one person that always handled the slot machines. And there was a company that would maintain it and collect the money and then give the portion they were supposed to have to the organization. What was happening was that the member was skimming the first 50% of the funds and splitting it with that vendor. So the way that it was discovered was because that member was suspended for another reason. But when that vendor came in, they asked the other person that was then there saying, oh, do we have the same deal in place? I mean, that's pretty obvious that something's happening, but that's what got everybody started. They asked what that deal was, and then the vendor obviously didn't want to talk about it. But as we went to the investigation, we could see that that one person was collecting substantial amounts, and as soon as they weren't there, the revenue from the slots doubled. So it's interesting because there's collusion. It's very difficult to catch collusion. That's actually one of the hardest things to find, because if you have both sides of the transaction, same to not having segregation of duties, that person can record it in a way that you're never going to find it. But in terms of looking at those red flags, during this fraud period, the perpetrator bought a $90,000 boat. It was on a fixed income. It didn't make sense for them to have that kind of income to spend. And then they thought they were being smart, but they were keeping the stolen funds in the form of cash at their home. And obviously it didn't hit the bank, so they didn't think that they would see the bank statements to know that. But when someone went into the home to try and find this out when the police were involved, that's ultimately how they found some of that. So the total loss of this was about $450,000 over the 3 years. So this is just some quick facts for you, but most organizations will lose about 5% of their revenue annually as a result of fraud. And the median loss was about $125,000, and a quarter of the cases exceeded $1 million. In 86% of the cases, the fraud was in the form of asset misappropriation. And the average length of fraud was 14 months before it was detected. So if you put those things in place, that'll help you catch it sooner, which obviously would then stop the damage from accruing. And just in conclusion, frauds can happen to anyone, to any company, and can be committed by anybody. Usually though, it is from a trusted partner or employee. And that's because they usually give them more access to things. Make sure you implement some of these internal controls and segregation of duties, which will help prevent fraud or at least deter it from happening. And always look for the red flags and consider the easily committed frauds, specifically for the type of employee you're dealing with. Ghost employees tend to show up for people that are payroll staff because they can input extra employees. You can have fake expense reimbursements for sales staff that might be going out and meeting people, having networking lunches, etc. Inventory tends to be stolen by warehouse staff, and revenue tends to be misstated by executive staff. So just keep in mind what might be happening, who has access to it, and what could possibly be stolen. And then the other thing that's really important, I'll keep coming back to the tips, consider a way to receive anonymous tips so that your employees are willing to talk to you about it without fear of some sort of repercussion. Since most frauds are determined because of tips, find a way to actually get those tips come to you.
Okay, Robert, or should I say Detective Carter? That's amazing. Those scenarios just run the gamut, and it can happen to anybody. If you do have a question, please, I know it's about 12:30, but if you do have a question, please put it in chat or the question and answer area. I do have a quick question for you, Robert. Many of us may be running our businesses and we don't have the actual employees sitting with us, meaning that we hire a bookkeeping service or we hire somebody in. So how do we know that the bookkeepers are you know, on the up and up, and how can, it's kind of one step away from us. So
Mhm. No, that makes sense. And that's actually a really good point. Obviously, the first step is to make sure that you've had some recommendations, make sure you have a reputable person to begin with. But beyond that, make sure that you are still looking at the books and records yourself. I know a lot of owners don't like to get into the finances. It's not their strong suit, which is fine. But take a look at your bank statements, take a look at what's being recorded, and see if things actually make sense to you, especially when you're talking about a bookkeeper. It also depends if your bookkeeper has access to cut checks or not, or do ACHs. If you're having them do everything for you, you really need to be a lot closer and more involved. If they're just recording entries for you, I think there's less concern. Because if they're just recording what you've already done, they probably won't be able to commit as much fraud, other than if they're manipulating something.
it's funny that you say to review. I remember a long time ago, I heard that Oprah, she was
Mm-hmm.
the only one that was allowed to open her bank statements first.
Mm-hmm.
Um,
Right?
so she wouldn't let anybody else open them. And we all see how
And
much money she has now.
yeah, no, that's actually is a great idea, and that's usually what we suggest to people, is to be the only one, or at least the first one to open them. Some of the things I see pretty regularly is that the statements get messed up. They take parts of them out. Some people get rid of the canceled checks, or they will take off a last page or delete some things, and then people look at it and don't realize what's happened. So it's definitely a good idea as an owner to have statements go to you first.
Yeah, well, unfortunately, it is part of owning a business. This stuff does happen, but you gave us some really, really great tips. So thank you again, Robert. Hertzbach and Company is, like I said, a member of the chamber. We actually would have many of our meetings at their offices. They're a great supporter of us. If you do need any forensic, if you do think you might have some fraud going on, you can contact Robert. Or if you just need some regular old really good accounting work, they do that too. So Robert, thanks so much. This is recorded, as everybody understands. So if you'd like to share this with anyone, just watch our Facebook page for the link. And Robert, I'll give you the last word.
All right, well, thank you for having me. And everyone, if you do have any questions, feel free to reach out. A lot of times we do want to help put those controls in place, and it doesn't necessarily need to be a traditional engagement, but feel free to reach out if you have questions, because we want to try and help people out as much as possible.
Okay, thanks everybody. Stay safe, wash your hands, wear those masks, and we will see you next Wednesday, hopefully, for our virtual we're going to do a virtual regular networking, and then we're going to have a virtual happy hour too coming up, so watch out for that. All right, thanks, Robert. Everybody stay safe, and I'll chat with you later. Bye.
Thank you. Bye.